Have you met with him? Gary Gensler did meet with him. Did you meet with him?
So I met with him, but the reason specifically is he has a registered derivatives platform. FTX has a registered derivatives platform with the CFTC. It's operational. It's not in bankruptcy. And about a year ago, in December of 2021, FTX came in and submitted an application to amend their existing license. So for the past 10 or 11 months, Sam and his sort of senior leadership team has been coming in a lot to the CFTC to advocate for the amendment to get it passed by the commission.
And when you met with him, Gary Gensler did meet with him. Did you meet with him?
So I met with him, but the reason specifically is he has a registered derivatives platform. FTX has a registered derivatives platform with the CFTC. It's operational. It's not in bankruptcy. And about a year ago, in December of 2021, FTX came in and submitted an application to amend their existing license. So for the past 10 or 11 months, Sam and his sort of senior leadership team has been coming in a lot to the CFTC to advocate for the amendment to get it passed by the commission.
And guys, I give you the truth. Nothing but the truth. Yes, the truth hurts, but it sets you free. But when I give you the truth, you hate me. And guys, we know the devil is in the details. The only thing you have to do is sit back, get your popcorn, and let it play out. And now that we let things play out, now a couple of days ago, guys, I put this clip of the CFTC chair on CNBC saying that he has been meeting with Sam Bankman-Fried on a constant basis about the derivatives platform. And like I said in that video, his mic went out when he said that that platform is not in bankruptcy. Guys, we know everything is going to be tokenized and put on blockchain. And what's going on blockchain, guys? LIBOR. And you know I did a video about Ameribor, SOFR. Guys, this is hundreds of trillions of dollars. This is the most important rate there is. And I'm not even going to go deep into that because that's a rabbit hole nobody wants to go into. A lot of people ended up missing. But guys, you have to understand how important derivatives are to the market. And they want to tokenize it, plus take the middleman out. And that's the reason why this video is going to be a little longer than normal, but I need for you to listen to it so therefore you understand what's going on. We know about the fourth industrial revolution, but the masses don't. But this video connects the dots. I'll let you listen in. I'll be right back.
It will affect every farmer because they will have to be up, as Mr. Edmonds said earlier in his testimony, at 1 o'clock in the morning on a Saturday, finding out that they just lost their hedge on their crop that they already have in the ground. Why? Because they got auto-liquidated.
Help me understand the auto liquidation point that Mr. Duffy's making.
Yeah, so I can tell you how I see it. Obviously, different people have different viewpoints on it. But the way I see it, you have some user that's put on a position. There is some collateral for that position. In our case, it is held transparently with the clearinghouse. At some point, if markets moved far enough against that position, they would be out of collateral. And at that point, the position, in our model, has to be closed down because otherwise they would be more than out of collateral. Their account would be net negative. There are a few options for what you could do there with different risk models. One thing that you could do is have a recourse-based risk model where you let them keep the position open and then go after their house. If it gets negative enough, that is not what we intend to do. We intend to instead deleverage the positions if they're out of collateral. But on the point of the speed and of the risk engine, right, of whether you're liquidating quickly or whether you're waiting a few days. If you wait a few days to do it, you have a choice between either beginning a margin call liquidation way earlier than may be necessary in case markets move against that position over the next few days, or waiting until a position is almost underwater and might be way beyond bankrupt by the time you could finish that liquidation, leading to scenarios like what we saw with LME. Yeah. The advantage of the real-time one is that you can actually precisely measure where a position is, wait to liquidate until the last moments that you preserve the positions if at all possible, while still protecting against systemic risk.
I want to let Mr. Duff get in here, but also All right.
Absolutely. So there are a number of things. We've gone through an extensive process with the CFTC on this, on the details of the model, on the back testing of it, both the historical data with simulated data, under all of the necessary standards. In addition to that, we've been running a model that this would be more conservative than internationally for the last 3 years. It has gone through days with 40% moves in markets in a single day. We just went through a 40% move over a few days. It has been functioning well in that environment, handling tens of billions of dollars of daily volume. We've never had to mutualize losses. We have never gotten close to that point. The entire insurance fund draw over the history is a tiny fraction of what we're proposing for our own skin in the game for the initial guarantee fund. And so that's sort of an empirical test on it as well.
It is, and I know you said you're not against it. You just don't lead the charge, and but it's a hell of a disruption. Let's face it, and doesn't mean you're wrong. Help me understand. I mean, so are you saying no? Are you saying not now? I mean,
I'm
Mr.
saying
Lucan's statement was exquisitely worded. He just doesn't want to do anything right now. Wants to look at it more. Very thoughtful. Tough debate. What do you think?
I believe that there should be a formal rulemaking process at the Commodity Futures Trading Commission where everybody gets to participate in that process, and do not make this just about crypto. Make it about market structure. That's what I'm here to discuss. And on that proposal of auto liquidation, so one of the things that FTX does not tell you, or this committee, is what they do for collateral. When I take on collateral, whatever form it may be, cash, treasuries, gold, whatever I have a mix of, we have to haircut that at a certain value. Their haircut on their collateral for Bitcoin is 5%. Their margin to trade Bitcoin is 15% of margin. This auto liquidator will be going with smoke coming out of it at those price levels. That is the problem with this application, and you need to hear the whole truth about this.
Thank you.
Gentleman. To your statement, sir,
Your statement.
I agree with your statement wholeheartedly. I am very concerned that the commission is unilaterally looking to make a proposal for a single asset class. And if, in fact, they do that, they would have to amend the application that is put forth already today by every legal mind in the world. And once that application is amended, it is open to all asset classes. So otherwise, it's deemed arbitrary, and the commission cannot be arbitrary. And Mr. Lucan knows this as well as anybody. So we would have no other choice, because this model, as I said earlier, is a cheap way around jurisdiction, and we would have to compete in it. Otherwise, I'm going to have either FTX or somebody else competing in the asset classes that I'm trying to provide liquidity and risk management for across the board. And that includes every single commodity known to man: wheat, corn, soybeans, right across the board, energy, natural gas, mortgages, foreign exchange, equity futures, everything.
Which affects
Chief Executive Officer of CME Group, the world's leading derivatives marketplace, offering futures and options contracts across every investable asset class. Risk management and innovation are hallmarks of CME Group and have always been fundamental to centrally clear derivatives markets in the United States. Under false claims of innovation that are little more than cost-cutting measures, FTX is proposing a risk management light clearing regime that would inject significant systemic risk into the U.S. financial system. The FTX model would come at the expense of proven risk mitigation practices, market integrity, and ultimately financial stability. In fact, the FTX proposal would significantly increase market risk by potentially removing up to $170 billion of loss-absorbing capital from the cleared derivatives market, eliminating standard credit due diligence practices, and perhaps most importantly, destroying risk management incentives by eliminating stakeholder capital requirements and mutualized risk. The FTX proposal to instantaneously auto-liquidate any customer who is under margin at any given moment in time would jeopardize both market integrity and financial stability. Auto-liquidation can exacerbate volatility and create dramatic price moves during times of turbulence. In an already stressed market, these automated liquidations could lead to a repeated pattern of price declines followed by additional liquidations. This has the potential to build losses on top of losses and destabilize markets for all participants. Furthermore, FTX's market maker and backstop liquidity provider plans imported from its offshore practices in low regulatory jurisdictions raises serious questions about the potential conflicts of interest embedded in the FTX model. Finally, the FTX proposal eliminates critical customer protections. Under their model, market participants will lose important customer segregation protections and could be exposed to increased collateral investment losses. And non-defaulting customer positions, let me repeat that, non-defaulting customer positions could be terminated or collateral liquidated at the discretion of first line of defense against losses for any reason under any market condition. By contrast, U.S. clearinghouses like CME Clearing have billions of dollars of resources available in the default waterfall that must be used to cover losses prior to any possibility of a position tear-up. The FTX proposal is not innovation. It's an invasion of best practices in prudent risk management. And while the Commodity Exchange Act may promote innovation, it does not promote innovation for the sake of innovation alone. In order to approve the FTX proposal, the CFTC must determine that it complies with the core principles and is in the public's best interests. We do not see how the Commission could credibly make this finding or legally limit its approval, even on a test basis, to crypto only. If the Commission makes its finding for crypto markets, they will not be able to keep FTX or others from expanding into other asset classes. To suggest otherwise would put all market participants at an extreme disadvantage. Market structure changes would affect the entire industry, not just FTX. And all platforms must be able to participate under the same rules at the same time. Accordingly, the CFTC should either reject the FTX proposal or commence a formal rulemaking to allow a broader public discussion of appropriate risk management standards. In conclusion, let me make one final point. As you know better than anyone, Chairman Scott, you and this committee have spent enormous time, you mentioned it in your opening remarks, and energy defending the CFTC standards and regulatory oversight as equal to or better than any other jurisdiction in the world. If, in fact, the CFTC decides to approve a rushed and ill-conceived proposal, we believe the hard-won cross-border equivalence agreement that you referred to could come under question. Just a few weeks ago, sir, a senior European central bank official warned, and I quote, "The crypto market is now larger than the subprime mortgage market was when it triggered the global financial crisis." To put this into context, the subprime mortgage market was at 1.8 trillion in 2008. Today, the cryptocurrency value is north of 1.8 trillion and growing. The stakes are extremely high. Exempting FTX from a well-established U.S. clearing rules could undermine confidence in our regulatory regime. Therefore, I applaud you, Mr. Chairman.
And members of the committee, thank you so much for having me here today. A bit about myself. I went to MIT, majored in physics. I worked on Wall Street at Chain Street Capital with the goal of donating what I made. And I got involved in the digital asset ecosystem in 2017. In 2019, I founded FTX, a global cryptocurrency derivatives exchange. In 2020, we launched our US arm, FTX US. And in 2021, we acquired LedgerX, now FTX US Derivatives, a CFTC licensed clearinghouse and marketplace. Last year, we submitted an amendment to our clearing order, which would allow us to operate as almost every other clearinghouse does, with margin. We have spent tens of thousands of hours talking with the Commission about this proposal and thousands of pages of documents. We really, really deeply respect the thorough process that the CFTC has undergone, the amount of time that they have spent digging into the details of our proposal, challenging it where appropriate, and the seriousness with which they are treating this proposal. We respect the CFTC and their process and whatever conclusions they ultimately come to. I will note that while our proposal does combine things together in a way that I think might bring powerful innovation to this space, each of the elements already exists in CFTC licensed derivatives exchanges, including ICE NGX, LedgerX, and others. I believe that the amendment that we put forward would help promote healthy markets. I think that would promote fair and equitable access to platforms. In particular, traditional exchanges charge for market data such that only the largest traders are able to get full knowledge of the markets that they are supposed to be trading on. With FTX, all of our market data is 100% free, transparent, and public. All users, regulators, and other observers have full access to our market data. Traditional exchanges have separate models for the largest traders and for other users, such that only the largest traders have direct access with lower latency fees and more options. We would have equitable access to our platform, where all users can choose the method of access that they most prefer and have access to the most powerful tools. We also have strong customer protections under our model. It is a safe and conservative risk model, which would have helped to alleviate some of the instances that we've seen with recent future exchanges, like the LME nickel fiasco earlier this year, by having the collateral pre-funded at the clearinghouse rather than relying on credit, and having a real-time risk engine. We also have enhanced customer protections. We have all of the customer protections that exist on traditional futures exchanges and on FCMs, because we understand deeply that we have a responsibility to ensure that if there is direct access to the platform, that users are still afforded the same level of protection. On top of that, we have further customer protections, suitability, and transparency than what you find on most other platforms. Finally, we believe that this would bring competition and innovation. It would bring liquidity to the U.S. marketplace and options to U.S. consumers. It would bring competition in the futures market, where almost all of the volume is traded by just two exchanges. And it would bring competitiveness to the United States with respect to the rest of the world. Today, 95% of digital asset volume trades overseas. And that brings me to some of the broader context here. Digital asset marketplaces need federal oversight. They need that oversight to protect consumers, to protect against systemic risk, to bring liquidity back onshore, to ensure U.S. competitiveness globally. This is good for the U.S. economy, for Americans, for wealth creation, and good for our consumers. The CFTC is an appropriate regulator to provide this for digital asset futures contracts. They have been doing so on CME and other platforms for a number of years. They're a thorough regulator who understands this space very deeply. Thank you to the committee for having me. I guess there's a few different answers, a few different things going on. To one of those, it's absolutely important that we still have protections against fraud, against scams, and some of those protections are often provided by intermediaries like FCMs. To the extent that they are, it is absolutely incumbent upon our platform to have those same protections. We do have those. That is a piece of our proposal, and the entire platform is under CFTC oversight, and they would be enforcing that would be true as well, that all of the necessary customer protections that typically exist were in there. Talking about the the point that you raised about the capital, in addition to the first line of defense being our own skin in the game rather than our customers or intermediary skins in the game, in our model, the initial margin for the positions is posted directly to the clearinghouse. And so in addition to that guarantee fund, there is a lot of capital which is held directly with CFTC oversight, segregated accounts, for margin for the customer's positions, which also provides a capital backstop for them, and does not require trust on that side. I'll just last say that for institutions that do want to access it through intermediaries, as I imagine a number of them would, we're absolutely open and excited to work with FCMs on that front for them to fill a role as intermediary, especially for their existing clients and other clients who want their services, as many do. And that when you talk about extending credit, that is something that an FCM could come to an agreement with their clients.
Now, guys, I told you from the beginning the Bankman was nothing but a puppet. Him being seen with politicians, the actual Democrat donations and Republican donations, no board, no CFO. Guys, this all makes sense when you look at the bigger picture, because he was on a project. a test run for what they want to do with the actual derivatives market. And if FTX had a clearinghouse, they would have had the liquidity, so therefore they could have kept running. Now we had the CEO of CME Group, Terrence Duffy, and guys, I've done videos on CME. We know water futures. We know they're crooks also. But he wanted to block the proposal to directly clear customers' margin-backed derivatives. And basically what he was saying, that if it starts in crypto, it's going to move right through the market. And he's exactly right. And we know that's what the NWO wants. They're going to tokenize and put everything on blockchain anyway, for the fourth industrial revolution. And guys, make sure you go to my stock channel and watch the video I put out yesterday. But let's get into the crypto video.
We're going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
This effort, and China has big plans for this. They intend to seed their digital yuan into the global environment by giving it away to visitors at next winter's Olympics. When they arrive at the airport, they're going to get yuan digital wallets. They're going to receive digital yuan. They're going to use it throughout their visits to Beijing, and then they're going to take it back to their home countries. They see this as a huge advantage. Why? Because who controls the underlying protocols, who controls the underlying standards of the future of money will control the future of money.
Welcome to the Crypto Teacher. And guys, please like and subscribe if you do like what you're listening to. Inform your friends and family and spread all over social media. It is imperative that we get back to learning finances and understand how the world really works. Because once we understand how the world really works, we understand that it is all planned out. Now, I want to thank those who purchased the books, Cryptoteacher and the New World Order book. The New World Order book is going to show you how the world really works. And it's definitely time for you to wake up out of that sleep, especially in the times that we're in right now. I told you at the beginning of the year, in the first quarter of 2022, we was going to have an event that was going to bring us down. And then also in the fourth quarter, we would have an event that would bring us down. That's exactly what happened. And now I'm going to tell you, in the first quarter, we're going to have an event that's going to bring us down in 2023. And then also in the fourth quarter of 2023, we're going to have another main event. Now, of course, guys, the markets are still going to be pumping and dumping until they get ready to pull the full rug. But I'll let you know when that's about to happen. Now, also, I want to thank those who purchased the 3 kids' books. It's time to get re-educated. And also, much love to those who donate to the Cash Shop and Patreon. And in my Patreon, I keep you up to date with the New World Order events. Also, I give you the New World Order cryptos in the Patreon. Of course, you have to do your own research. But this next bull run is going to be a utility run. So you want to make sure that you have the cryptos that have utility. And much love to those who are shopping at both stores. Keep it coming. And of course, guys, we get into Bitcoin and cryptos first.
Don't forget to like and subscribe to the channel.
And guys, I know this video is way longer than normal, and I know it's Friday, but I had to do it. But guys, we have Bitcoin and cryptos pulling back. We know why. We have options. And also we have the stock market flat. But can Bitcoin hit 12,000 and can Ethereum hit 800? And yes, it can. And guys, my target for this year for Bitcoin was 14,000 as the low. And my target for Ethereum was the low was 700. But that was before the actual change over to proof of stake. And we know proof of stake dropped the actual supply on a daily basis from 13,000 to 1,600. So guys, it's like a 90% drop. But we know the Fed is not done yet, so it definitely can touch that $800 mark. Now we have CME Bitcoin futures trade at a discount. And guys, we know when there's a discount, that means that someone is definitely selling. But guys, don't forget to pay attention to the actual indicators. We have yield rates, which are slowly rising, but we know they definitely plunged. And then, of course, guys, we have volume, Tether, USDC. And we have Cardano issued regulated stablecoin, USDA, launches early 2003, Emergo. And we know Cardano has been steady in Africa. And we know all these major projects are over in the Middle East, over in the emerging markets. And why is that, guys? They're pushing the fourth industrial revolution. Remember, they don't have the infrastructure, so it's easier for the NWO to lay out the plan there and then hit the Western nations. And then, of course, guys, we have the Fed. Repo still over $2 trillion. And like I stated, they're going to be raising rates December 14th. So they're definitely not done. And then also next year, guys, we know they're going to be shrinking the balance sheet. The Republicans take over the House. So they're going to be stepping up the Hegelian dialectic. And we know all the distractions they have going on. The masses are going to stay asleep while they build this fourth industrial revolution. Whether robots, algorithms, and drones take over the economy, pay each other with crypto, and the sheep go inside the metaverse. And those who watch my stock channel, we know we heard Klaus say that out of his own mouth during the G20. Guys, they're being honest about everything they're doing. And then, of course, guys, we have Grayscale at about $14.7 billion. But getting over into a little crypto news, we have the pensions giant Ontario Teachers plans to write off the full $95 million invested in FTX. And guys, FTX wiped out $183 billion. And guys, we know that is definitely not correct. We know who was behind that. That's right, the Fed. They don't tell you they're going to take your money. They always set up the big distraction. And then we have the Bahamas securities regulator says it ordered FTX crypto transferred to government wallet. And guys, we know the hands that money is going to end up in. And lastly, we have Ripple seeks crypto license in the Republic of Ireland. And again, guys, we know these big projects. Ripple is over in the Middle East and the emerging markets, and now has plans to take over Europe's cross-border payments. And remember, the crypto teacher told you, because he knows when it comes to the New World Order, it's all planned out. But guys, all I have for you. Don't forget about the books, Crypto Teacher and the New World Order book, plus the 3 kids books. It's time to re-educate. Also, if you're new to cryptos, Coinbase, Bitrue, Binance, do not forget book links and crypto links are in the description. The stock channel, guys, make sure you go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get home stocks and see where the biotech stocks. And while everybody's at home wishing they were still getting that free money, what they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know, I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID-33. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.